Neal Falkenberry, CFA, and Managing Director of our Reston, Virginia office. Welcome. Thanks for taking some time to be here with me as we talk about what to look out for in 2026. This is kind of an economic outlook, a market outlook, and obviously we don't have any crystal balls, Neal, but there's a lot of things that have happened in our experience in this industry, and I'm nearing 40 years. What about you?
38.
38. So you and I are about the same time. It was actually 1987. 1987 for me. Was that the same year?
Yep.
Yeah. So there we go. Mm-hmm. Here we are together. So we've seen a lot. But everybody seems to think that this time is different. We've had markets kind of defying gravity this year and just a lot of things going on. So we're going to spend the time, go through some charts here, and then talk big picture about what strategies people should be employing as we head into 2026. So Neal, start us off here and what you see as kind of maybe the three big themes that are going to be facing us in 2026.
Yeah, great, Dean. Thanks very much. Yeah, Dean, I think we'll need to draw on all that experience as we navigate through 2026. But I think I'd start with, I think there's three primary themes to be on the lookout for, or have a view on going into next year. By far, the most important to me is this dynamic still between inflation, interest rates, the Fed trying to cut interest rates, and having their hands a bit tied. I think ultimately this is the issue that's closest to the consumer.
Okay.
So real briefly, let's view inflation. So on the screen now is inflation going back to about 30 years. And you can see this spike in inflation up to 9.6 following all the stimulus around COVID, right? That inflation peaked at 9.6. It's been coming down. It reached a low of 2.3. That has given the Fed room to cover, right? Obviously, the Fed had to raise interest rates in response to that peak in inflation. It's now come down. That gives the Fed room to cut interest rates. But if you look to the very far right, we've now had 6 consecutive monthly increases in CPI. We're back to 3%, right? Fed funds rate today is at 4%. Fed's got a tough decision when they meet again in December, right? I think if I had a vote here, I would probably err on the side of pausing interest rate policy until we see what's going on in inflation. Because the source of inflation, it would be very tempting, I think, to kind of point to tariffs. I mean, that's obviously been a big topic of 2025. But it's really not what's driving inflation. What's driving inflation is rents, sort of housing in general, healthcare insurance, homeowners insurance, auto insurance. These are all domestic issues. They're not impacted by tariffs. So is the Fed going to be able to cut rates? And that really depends on the outlook for inflation. So if we look now at the 10-year Treasury, right, this is the interest rate that is most important to consumers. And this interest rate has not budged much whatsoever.
So Neal, before we get into the next chart here, and I'm going to make this part of our program. Before we get into the next chart here, Neal, let's talk a little bit about this whole idea that prices are coming down, because just because inflation is slowing doesn't necessarily mean that prices are coming down. Once prices have gone up, what we're talking about here is a slowing in the price increase, not actually a decrease in prices, right?
Absolutely. So inflation is a rate of change. So if inflation was 10, but now it's 2, prices are still going up 2% per year.
Right. So it's not like we're going back to where we were pre-COVID. We're in a new normal as far as prices here. It's just how quickly those prices are set to increase in the future. That's what we're talking about here when it comes to this current inflation.
Absolutely. And a trip to the grocery store will confirm that.
Yes. I just did that. Did that shopping for Thanksgiving.
Yeah, absolutely. Yeah, I think the cost of Thanksgiving, actually, that's an index that we track. Cost of Thanksgiving is up about 6% over last year. Last year, it was up almost 8%. So, grocery store inflation is still a very real thing. Prices are not coming down. They continue to go up. They're just going up at a slower pace.
That increase is not because your relatives are eating more. It just means that things are more expensive, right?
Exactly.
All right, so let's go where are we at on that 10-year Treasury now, and what are we looking at for 2026?
Yeah. So again, in context, the Fed knows it needs to cut rates. if inflation were lower, it would absolutely start cutting rates. But the 10-year Treasury is the yield that we care about, right? This is the yield that determines mortgage rates, real estate valuations, to some extent, equity market valuations, and it's very unimpressed, right? So far, that rate, the 10-year Treasury's been very steady now for almost 2.5 years, right at 4% with very little variance. So the Fed used the term transitory on inflation. I think the bond market is saying, sure, inflation was transitory, but this decline in the rate of inflation is also transitory. And we're finding out this new normal level of inflation that's probably closer to 3% than the Fed's target of 2%. If that's true, if inflation is up 6 consecutive months, it's around 3, that's going to be very difficult, I think, for the Fed to cut in December. That's going to make it difficult for long-term rates to go down. And today, mortgage rates are about 6.4%. That's the rate that's most important to consumers right now for a refi opportunity. I think that's going to be challenging for next year.
So this is where you come into the whole home affordability issue, right? I mean, when interest rates went up on that 30-year mortgage or the 15-year mortgage or whatever mortgage it is, it doesn't matter. That really changed what monthly payments would be for the consumer out there that's buying a mortgage or buying a house, putting a mortgage on it, or even forced to move or relocate due to company changes or whatever. Look, that's a big deal. And if those rates don't come down, Neal, that affordability issue is going to continue to remain something that's going to be horrible. And I think that exacerbates the problem, because then the apartment complexes can say, well, housing itself is up, so we're going to raise our rents. And there you have that cycle of all the things that continue to increase that are, like, as you said, are domestic issues. So how does the Fed tackle this? And this is why I think Trump has been saying, hey, we need to cut rates, and we need to cut rates now. He's looking at home affordability. He's looking at mortgage rates. Is that something that we're going to see happen in 2026, or are we going to see more of the same, staying in that 6 to 6.5% range?
So it's a great question. And I think it's interesting that Trump talks about the need to cut interest rates to bring mortgage rates down to help affordability, because one of the obstacles standing in the way of lower rates, I think, is deficit spending. Right? We're going to talk about that here in a little bit more detail in just a second. But higher deficit spending from Washington is putting a floor underneath the rate of inflation, which is also putting a floor in under interest rates, right?
And we talked about that here a few months ago, and we talked about what was driving gold. So this will be familiar to people that are watching our educational programs here, Neal.
Yeah, so I think the challenge for next year will be several fold, and it's really more of a planning opportunity, I think. So let's take two different scenarios. So let's say the Fed is successful, rate inflation comes down, the Fed can start cutting interest rates. That helps affordability, that'll help the economy, that'll help the market. That's good. Those lower rates, though, then become more challenging for a portfolio to generate income. And so if that drop in inflation is not met with a decline in inflation, then your financial plan could easily be in a situation where you have the same level of pressure on budgets, right, from inflation, and yet your portfolio is going to be more challenged unless you take action to generate the same level of distributions you've had in the past.
Let me just see if I can help everybody that's watching this out with what you just said, Neal, because really, if we go back over the last 20 years, the last 3 years has been the first time in the last 20 years that we've actually been able to invest for income as opposed to invest for total return. Our clients in retirement, we've been forced to invest for total return for the better part of the last 2 decades until just recently. And that's because interest rates have come up to a point where now our safe money can actually give us some income. But what you're saying is, hey, we may be, if rates come down, we're going to have to go back and focus more on total return. Is that what you're saying?
It is. I don't think we'll go back to the zero interest rate era like we had from 2010 up until COVID. But in general, Dean, I agree with you 100%. Your rates coming down puts more pressure to generate income. That forces you to focus on total return, which by definition puts you a bit further on the risk spectrum. You've got to have more equities in your portfolio. You've got to have longer duration on the bonds in your portfolio.
So let's look at where we are right now with the Fed funds rate. And you got an interesting chart here that talks about the Fed funds rate, it talks about inflation and all those different things. So, Chris, it's the interest rates.
Dean, this is a chart of the Fed funds rate, right? The line in blue. The red shaded periods are recessions. And there's a relationship here, right? When the Fed raises interest rates, almost always in response to a resurgence in inflation, right? The only way to combat inflation is to slow the economy, right? They're one and the same thing. Slowing inflation requires a slowing economy. So the Fed raises interest rates. It then keeps rates elevated for long enough to allow enough individuals to have to refinance at higher rates. Eventually, you have to downsize your house, upsize your house if you have more kids, move across the country if you have a new job. Eventually, if the Fed leaves rates elevated for long enough, enough people get pulled into that higher interest rate pool. Same thing is true on the business side. Business loans usually have a 3-year balloon note loan structure. Those loans reset at higher rates. That then hurts margins, right? That's the mechanism of how higher rates start to slow the economy. And the relationship in history is that most of those rate hike cycles lead to recessions, right? That's true of the hiking cycle in 2018-19, 2005 through 2007, 1997 to 1999. All of those led to recessions. The Fed talks. So
this chart, it's interesting as you look at this chart, Neal, that the recessions didn't come until some period after the Fed had begun to lower rates.
Yeah, the Fed, they always start after the Fed starts cutting rates, right? And it's not that rate cuts cause recessions, it's that the Fed is cutting for a reason, right? And they see that those higher interest rates have started to have a detrimental effect on consumers, on businesses. Unemployment starts to pick up, right? So we've gone now from 3.5% unemployment to about 4.5%. Still very healthy labor market, but the trend is that exactly what you would expect to happen from a rate hike cycle is happening, right? We see consumers struggling with affordability, with higher interest rates. We see higher delinquency rates on credit cards, home mortgages, auto loans. It's a very typical cycle, Dean. And we go back to our initial comments of being in this business for 35 to 40 years. We've now seen 8 or 9 of these cycles. So there's nothing new happening in this cycle. I think we know.
No, there is, but there is something different. And that is our deficit spending. So let's take a look at that deficit spending slide here, because this, I think, is the key to why maybe there may not be a recession this time.
Right.
Talk about what we're looking at here, Neal.
Yeah, I think you're spot on. And you referenced that we did a deep dive on this on the episode maybe 2 or 3 weeks ago. But to review this, the outlier in policy, what's completely inconsistent, is the level of deficits that we're now running, right? Deficits are pro-growth, right? It's something you do in a recession or a pandemic when a consumer is unemployed and unable to get to work and revive economic activity. The government steps in, runs a deficit, becomes the consumer of last resort, if you will, and helps get the economy going again. But in this case, the Fed's trying to slow the economy. We're at full employment, and yet we're still running these massive deficits that started during COVID, and that politicians and citizens, all of us, have become addicted to a lot of these spending programs. Those deficits are pro-growth, right? They're borrowing from the future to stick consumption into the present, to leave debt into the future. That encourages economic growth. That's probably why we've avoided a recession, but it also puts a floor underneath inflation, right? How can inflation come back to 2% when we're running a 7% of GDP deficit? That's almost 2 years worth of growth that we're borrowing every year to stick into today.
It's unbelievable. And you look at the chart and you're like, oh my gosh. So something interesting here is you've never had a recession start with deficits greater than 5% of GDP. And here we are at 7%. So yeah, that deficit spending, it's almost a stimulus is what it is. It's really fake money that's going out, and it's not real growth. It's pro-growth, but it's not real growth because you're borrowing from the future, as you stated. So it could be dangerous. I mean, so does that mean that when we do have the recession, it's going to be even worse than what we've seen in the past? Is that?
Yeah, Dean, it's growth in the extent of if you go to the mall shopping on a credit card now that somebody else is going to have to inherit. It's not the kind of organic, sustained growth that we want to have. Dean, I think I'm not sure I would weigh in yet on an opinion about does it make the recession that's coming, the next recession that we have, worse or not. I think what it means though is that we're running out of options. So if we're already running deficits of this size today, what happens if, that previous chart where we showed Fed rate hikes typically lead to recessions? We're not quite out of the woods yet on that, right? I mean, we're still seeing a consumer struggling with higher interest rates. What happens if we actually get a recession starting at deficits of this size? Are we going to run them to 10, 12% of GDP? And if so, we're now just creating dollars out of thin air.
That's hard for me to imagine, Neil. I mean, you look at just the interest on our debt today and where it's at. It's frightening that we've gotten to this point. So I agree with you that if we were to go into a recession now and we were to go into even deeper deficit spending, that's just, to me, it's almost like financial suicide. It doesn't make any sense that we would be able to do that.
Right. Well, Dean, what it is potential inflationary. And I think getting back to the risk in 2026, right? So imagine a scenario where the Fed just does continue to cut rates, and whether that's political pressure from Trump or appointees and the Fed becoming less independent, but rates go down, income to portfolios becomes more challenged, but we continue to run these large deficits so that inflation continues from 2.3 to 2.5. It's now at 3, goes to 3.5 or 4%. That's a real challenge for a lot of financial plans who have not modeled for higher inflation but lower income.
I see exactly what you're saying, right? It's you got lower rates, but you got higher inflation, and it's crazy, Neil, because prior to COVID, I would see people coming in and for the first time, and we're looking at, okay, hey, maybe they had a financial plan done before, but their advisors were putting in like a 1.5% to 2% inflation rate. I'm like, that's insane. You can't do that. That's not reality. I mean, maybe it's the reality of the moment, but you got to take a longer term look. And we always built financial plans with 3% or better inflation in them, and then inflating healthcare even at a higher rate, 6 to 7%, depending upon kind of where we're at, and that's typically what we're seeing. So. You're right. It is going to make it more difficult now. So we lay this landscape out there, Neil. Let's talk about where we're at as far as valuations on the market. You've got an interesting chart here that shows the valuation of the Magnificent Seven, the earnings growth of the Magnificent Seven versus the earnings growth of the rest of the market. So let's talk about the earnings growth of what we've seen happening in the markets, Neil. And we talked about how the markets have seemed to defy gravity. What we're looking at here might explain that.
Yeah, it's a good point. So today valuations are absolutely stretched on the S&P 500, right? We're trading about 28 times forward earnings. Historically, that's very high, but it's clearly backed by earnings growth in this case. So the blue line here is the Magnificent Seven. So these are your Nvidias, your Metas, your Microsofts. Those valuations are particularly stretched, but they're backed by 20% earnings growth, and that growth rate is actually accelerating, right? They are truly doing, these are spectacular companies doing remarkable things. The rest of the market, so the 493 stocks in the S&P, that earnings growth, that's the green line here, that has started to decline, right? But it is still 11.3, right? So the bad news here is that the large tech monopolies are really taking off, but your average company here is seeing at the margin more pressure on earnings growth. That's the bad news. The good news, though, is that it's still 11.3%. So if we think about total return from stocks coming from either the PE ratio gets larger or earnings get larger, we don't necessarily have to have multiple expansion. If we just stay here at current elevated valuations, and we get 11% earnings growth, you're still looking at double-digit returns in the S&P. That'd be a fourth year in a row. I think we're now at month 116 without having a 20% correction. I think that's the second longest in history, actually. So I think from this chart, you can be concerned about valuations going into 2026, but know that it's actually backed by earnings. particularly on the tech side. You need to watch earnings for the average company, but they're still very healthy. I think there's reasons to be optimistic and not think that the market necessarily has to decline in 2026 just because it's been up now 3 terrific years in a row.
Yeah, we got another chart here that shows the top 10 and the latest PE on the top 10, and then the remaining companies, and then the S&P 500 as a total. Explain what we're looking at here, Neal.
Yeah. So the green line is the performance of the 10 largest companies in the S&P 500. So those largest companies change over time, right? Today, it's the AI companies. Back in this really peak here at 45 times earnings that you saw in 2000, it was the dot-com era stock. So it changes over time. The blue line is the other 490 stocks in the S&P 500. So let's talk about those first. So if you look at that blue line, valuations are today about 20 times earnings as opposed to 30 times roughly for the largest 10 companies. So valuations are cheaper, but if you follow that line across the page, that historically has been about the peak for the non-10 largest stocks in the S&P. Okay. Look at the green line now. The green line has, the stock market has always been a market of darlings, right? Going back through history, whether it's railroad stocks or, defense stocks, whatever it's been at the era, consumer Coca-Colas of the world, the Nifty 50. There's actually precedent for these large companies to actually sustain higher multiples. Now, they usually come back to earth very, very quickly, unlike the blue line, right? The green line crashes, the blue line is much more stable in its decline when valuations come down. I can actually see room for additional expansion in these top 10 AI names to get to their historical precedent, even though the valuations are high, versus the average stock, the valuations are lower, but they're pretty much at their historical peak. That might be a consensus opinion here that there's more room for these AI stocks to run. I think it's very tempting to look at Palantir trading at 300 times earnings. Nvidia's trading at, I think, 45, 46 times earnings. It seems the easy trade would be to sell those and buy the less overvalued stocks. And I think that strategy might come at some point in 26, but I think there's still a bit room to run here.
So Neal, let's take a look now at what's going on globally, because we have these stretched valuations here domestically, but I think if we take a look at international exposure in a portfolio, we go back over the last 20 years, the vast majority of the time, international exposure has been a drag on a portfolio as opposed to a boost. That's been different here in 2025. Let's take a look at that chart so that we can look at the valuations on international stocks.
Dean, that's a great point. And I think the investment team here at Modern has really taken advantage of the underpriced, underloved opportunities in international stocks. I think we had a pretty healthy allocation going into the year. That was a real saver in the portfolio in the first quarter of this year when the U.S. market was weakening in expectation of the Trump tariff announcements. International markets were up 15% in that first quarter, so it really helped buffer that volatility in portfolios. But I think some of that opportunity has now been realized, right? So this chart is a scatter chart that shows on the bottom axis 3-year earnings per share, growth rates for the last 3 years for earnings. And on the y-axis, it shows valuation, so PE ratios. So the U.S. today has the strongest growth rate in earnings of any major region economically. Japan is actually now pretty close, right? That's a surprise. Earnings in Japan have really done very well. That market has up about 35% so far this year. And now it trades very similar to the U.S. in terms of this relationship between growth and valuation.
Yes, in fact, this valuation is a little bit higher than the U.S., even though its growth is a little bit slower. It's interesting, though, that the U.S. has more than doubled the growth rate or earnings per share of Europe.
Yeah. Being Europe looks to me a challenge looks a value trap, right? From an investment perspective. And a value trap is a market that looks very cheap looks appealing from a valuation perspective, but it lacks a catalyst to drive it higher. So there's just very little earnings growth in Europe. Germany has had negative GDP growth in 6 of the past 8 quarters. So it's arguably been in a rolling recession. And yet the ECB is running massive deficits, engaging essentially in a very QE-like program to help stimulate the economy. So stocks have done pretty well, but they've done well really in the absence of organic earnings growth. It's much more of a financial repression. Interest rates are low. Investors are forced to try to get returns somewhere. I think Europe is a bit more challenging from an investment perspective. What looks more interesting, I think, is China is now not cheap. Earnings growth has actually been negative for the last 3 years, but it has improved significantly in the last year. I think China's gaining some momentum. They've launched yet another stimulus program around its economy. It still has very real structural problems. But if we lump China in with emerging markets, that looks to be an area where you could diversify outside the U.S., get more core earnings growth in emerging markets, an improving picture in China. China should have a higher valuation once its earnings start to improve. I think there's still opportunities outside the U.S. They're not as compelling as they were a year ago, but still worth an allocation for diversification's sake in a portfolio.
So, Neal, let's wrap this whole thing together here. What does this really mean for the individual? And we can kind of break this into 2 groups. The people that are still in the accumulation mode, trying to get themselves to a point where they can be financially independent and they're working only because it's what they want to do. It's no longer about money. And then there's those people who are already there. They've achieved financial independence and they're asking their money to work for them now so that they don't have to worry about work anymore. Those are kind of 2 different scenarios. Let's tackle the person that's headed into maybe they're in the last 8 to 10 years as they're saving for their retirement years. How does a person look at 2026 from that lens? And then let's do right after that, the person that's already retired, that's relying on their portfolio to drive income for them.
Sure. Dean, for the client that's approaching retirement, and as a CFA and a lover of financial markets, I like to put market issues first. I think I'd actually put for 2026, my checklist would be RMD planning, Roth conversion planning, building out a plan in preparation of retirement. I think the alpha or the additional value that can be added in those sources might actually outweigh what can be done from an investment perspective next year, meaning I still think there's a lot of investment work to be done. I'm still fairly optimistic in terms of returns in spite of high valuations. I think there are just still so many planning opportunities for tax savings that are often overlooked until it's too late. I'd add Social Security planning into that mix as well. So put that on the checklist first. And then from the investment perspective, I still think you're okay to invest for growth, right? So I still think a hefty allocation to equities makes sense. But I think the things you're most concerned about is are we going to see continued rising inflation? That higher inflation is going to put pressure on the Fed to stop its plans to cut rates. That's going to make it more challenging for equity valuations. It just raises risk across the board. And so as you approach retirement, you want to have a plan to manage risk as well as Roth conversions and RMD planning, for example. For the second scenario of the younger investor starting to accumulate wealth, same scenario, I think, Dean. I think still you're okay to have an allocation to equities. I still think you can be overweighted equities. One, rebalance after 3 spectacular years of near 20% returns in each of the past 3 years. Rebalance so you're not too top heavy. And I think the idea of starting to look for what are you going to do if we actually have a scenario where the Fed does start to cut rates and the bond market becomes less appealing? Are you prepared to now start adding to your portfolio market neutral strategies, perhaps real estate debt, more alternative investments to your portfolio? So I would add that educational process and be open to adding that to your portfolio in 2026.
Neil, I think you pointed out a lot of great things there. And one of the things I'm glad that you mentioned was the rebalancing issue. And another thing that I want to kind of point out here from a financial planning perspective, that plan should be a living, breathing part of your financial life. And within that plan, you can always look at the investment side of this from an emotional standpoint. And some people might be getting a little bit nervous about how markets are stretched, no matter what you're saying here. And it could just be a gut feeling, right? And on the other side, they may be saying, well, I think there's a lot more room to grow here. Every single financial plan that I've ever looked at in the last 38 years has a sweet spot. There's a minimum amount of equities to make your plan work. And then there's a maximum amount of equities at which beyond that point is detrimental to the plan as opposed to helpful to the plan. So I think that it would be good for you to sit down with your certified financial planner or your advisor here at Modern Wealth and look at what's the minimum amount of equity exposure to make my plan work. What's the maximum amount of equity exposure to make my plan work without going too far, and really understand that, because that's where you can really dial up or dial down risk depending upon where you think you're at, Neil, without making an emotional decision. This is pure logic. It's pure math. It looks at, how does this portfolio work based on what you're trying to do. So maybe take all of what you talked about, Neil, and the things we pointed out. We're in, we're just in time. There's nothing special other than the deficit spending that is different about where we're at right now. And it's something that we're used to. It's something that we're prepared for. It's something that I think that people just need to say, hey, where am I at? Where am I comfortable? Do I want to take a little bit more risk? Do I want to get a little bit more growth? Or am I okay with a lesser amount of equity exposure moving into 2026? Make an educated decision though, Neil.
Agreed.
Well, again, Neil, thanks so much for taking the time to spend with me here as we give the outlook for 2026. I know we'll be doing several videos as we enter into 2026. We'll see what our predictions wind up like. And to all of you out there, thank you so much for sticking with us here. And thank you for the trust and confidence as you placed in your Modern Wealth Advisor. If you enjoyed this video, please like, share, and subscribe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.